Hi, it's Peyton, and I'm here today to talk about two of the most important things that we look at when qualifying a borrower for their home mortgage.
Hi, my name is Peyton Fullerton and I'm a mortgage loan originator.
First one would be your credit score. The credit score dictates not only whether you qualify at all, but it also can contribute to the interest rate that you receive on your loan. So some ways that you can get your score up if you're concerned about it would be to keep the balance on your revolving trade lines as low as possible. Revolving trade lines are things like credit cards, lines of credit, anything where what you pay down becomes available again for you to borrow against. A revolving trade line with a low balance in relation to the limit is really going to help your score. That doesn't mean to pay it off entirely. You do want to be actively using your credit and showing that you make on-time payments and can keep the balance low. Another thing to do is to make your payments on time, and also be sure that you don't have accounts that go into collections. If you do have accounts that go into collections, it may or may not be wise to pay those off. So definitely lean on us as your mortgage consultant to give you advice on that, because when you pay it off, it could make that activity on that trade line more current. And then my final piece of advice is actually when you're in the process of applying for a mortgage, you cannot have a dispute on your credit report, because that eliminates that debt from the credit score analysis. So we don't have an accurate idea of the credit score. So if you're going to dispute an item on your credit report, do it early, do it before you get into this process, because it's something that could delay you. So the number two thing that we look at when we are qualifying a homeowner is called the debt to income ratio. The debt to income ratio is what we use to determine how much you qualify for. There are two debt to income ratios. One is called the front end ratio, which is your housing ratio. That is the proposed mortgage payment divided by your gross monthly income. The general guideline for that is 30%, so you don't want your new payment to be more than 30% of your gross monthly income, but there is some leniency on that depending on which products you're applying for. The back end ratio is extremely important on every type of financing, and the general rule for the back end ratio, which is all of your minimum monthly payments that would show on your credit report, so things like your minimum payments on your credit cards, your installment debts, things like car payments, student loans. You add up all of those plus the proposed mortgage payment, and you divide that by your gross monthly income, and that would give you the total debt to income ratio, which is the back end ratio. That is very important. Lenders look at that, like I said, to determine how much you qualify for, and the general guideline for that is 45%. Some products allow a little bit less and some allow some leniency, but that's a good place to start.